The number three types of reports you need to run is your accounts receivable report, which is also otherwise known as your debtors report. I can tell you for free that a lot of businesses that has run into debt or that has crumbled are as a result of bad debt. What does this mean? If you run your accounts receivable report, you'll be able to know how much customers or how many customers are still owing you, and you can also calculate their aging days. Aging days are the category of customer that are owing you between 1 to 14 days, depending on the nature of the business you are running, in 1 to 30 days, the category of customer that are owing you between 30 days to 60 days, 60 days to 90 days. Now, if the backlog of your customer that are owing you from 60 days, 90 days, and 360 is more than the ones that are owing you from 1 to 30 days, that business is in risk. What that automatically means is that more of your customer, they are tying down your working capital that is supposed to be in the business, working for the business. The number four kind of reports you should run for your business operation to understand if you are growing is a stock movement report. It's known as your inventory report. The stock movement report is very important for businesses that are into products or trading companies. When you run your stock movement report, you'll be able to detect what are the fast moving SKU and what are the debt trap SKU. There are some SKU or there are some products that in your business that they are moving very fast. This is an idea that you should focus more on those products so that you can be able to turn over your working capital. And then you also be able to evaluate what are those debt trap SKU, those debt trap products that when you buy them, it takes you time, days, it takes you numbers of months before you're able to sell. Those are not the types of products you should be investing in that business. Otherwise, they are tying down your working capital. Another thing your stock movement report will give you or give you an idea is about your stock turnover rate. Stock turnover rate will tell you the efficiency of how much you buy into your warehouse and you're able to sell on time. If you're able to sell on time, this is a signal that your stock movement is doing very well. But if you are not able to turn over on time, then it signifies that more of your working capital are tied down in your inventory. And this is something you need to look into. The last type of report every business should run to measure if they're actually growing is the balance sheet report, which is also otherwise known as the statement of financial position. In this statement, every business is able to understand what they owe to outsiders and what they own to them. What you own to yourself in the business is the portion where it is called the asset side in the balance sheet, and what you owe to outsiders is known as the liability side. And then the equation between the both is the equity. Equity is the retained profit back into the business. Now, if the equity of that company is increasing, that is a very good signal that what you are investing or all the resources you are putting into that business is actually worthwhile. Another thing you need to look out for is the liability portion of the balance sheet. If the liability is much more than the asset, then that signifies that that business is under pressure. And part of the pressure that that can signify is that the business is either being run on bank loans, whether short term or long term. And these are things that business want to look into to ensure that they are not under any